We'll go ahead. Hey, how's everyone doing? Welcome to another webinar at PhilStockWorld.com, where we're doing the latest things on the things and the stuff that's happening. All right, so whatever happened, we just had a big pullback there. So, meanwhile, the run, I didn't know why we were having a run up in the first place. What's everybody so excited about? Fed this, Fed that, blah, blah, blah. We're waiting for the announcement of the Federal Reserve. That comes in a short amount of time. Here's what the day is looking like now. So we almost got back to yesterday's high on the Dow, almost back on the Russell, nowhere near on the NASDAQ, nowhere near on the S&P, and now we're up about a half a point across the board. So that's the short story. That was fine. We're not going to worry about that kind of stuff. A lot of stuff to go through. First of all, Warren, hello. What the frick? Okay. We're going to be looking at the Fed today. First, let's remind ourselves of the last, what do you even call it? Oh, here it is anyway. Fed minutes. See, here's the last statement. Move. So, whoop. Of the last statement. Okay. And here is the Fed's last projections. So you don't want to just throw stuff at an AI. You want to tell them as if you're telling an office assistant what you need to do. It's like you got to explain it to them a little bit, not just say, here you go, back, and think they're going to read your mind. So then we have to go back to 2024 now and find the last data from 2024, which was here. And then the question is, how much do we give before changes in GDP, uncertainty? Okay, we don't care about uncertainty. Uncertainty, GDP growth, distribution of judgments in the midpoints. Okay, that's the dot plot. And I think we'll cut it there. No, see, it gets too wonky. All right, let's call it there. So we need to remember now that we went up to 4A. Probably didn't need to do the 4s at all, though. We went up to 4A. Okay, when the new report comes out, It's March 19th because this is now a rebooted warrant for whatever reason. When the report comes out, we're going to want to do comparisons. Okay, so he's going to look that up. Here's a clear framework. Wow. Okay. he's got a whole plan here. All right. Well, we don't care about that. We really only care about the new report, but this is going to be, obviously he's putting a lot of thought into this. All right, good. So where are we? So now we're ready for the Fed, which will happen in 40 minutes or 30 minutes or whatever. All right. So what's been going on at PhilStockWorld? We've been doing the portfolio reviews, and let's talk about that a little bit. All right, so far we've done all of them but the long-term portfolio at the moment. Here's how the stocks have been for the last month. So this is what we skipped by lightening up and shorting on the market. You know, we missed all these. Basically, it's a 10% correction across the board, right? Apple, Amazon, Tesla, Meta, Google, Nvidia, Home Depot, Walmart, Costco. I mean, everything's down 10% pretty much. Morgan Stanley, Goldman Sachs, Blackstone. I mean, come on, BlackRock's not down. They don't care. And it's funny because BlackRock owns all these things. They're like the 10% owner of every stock in the world. Berkshire is up 8.85%. And that's one we picked right when the market was turning down. JP Morgan's down. American Express badly getting hurt. All the credit card companies are getting hurt because people are starting to default on their loans again. That's not a good thing. So we looked at the short-term portfolio. We've got a couple of $1 million worth of protection in the short-term portfolio. You know, look, if you want a quickie on these things, just look at when I do have to say I like to trade. Look for things I write in blue. Too cheap not to own. Those are suggestions. There's like 20, 30 suggestions that you can go into if you're looking for positions just in these portfolio reviews. So currently the SQQ spread, the whole spread is $631,000. It goes to 1.9 million, so it gains $1.3 million if the NASDAQ stays where it is. Doesn't have to go anywhere. And then if we top out, it's 2.4 million. It's another 500,000. So it's 1.78. So almost 1.8 million in protection just in that portfolio. And TZA has another 500,000 of protection. So we've got a ton of protection for our long positions. Here's a nice USO trade that pays off in 90 days. How much does it pay off? It pays 115%, has 115% upside in 90 days. Not 90 days, 30 days. So that's a good little, if you like quick trades, that's a fun quick trade. And if they're in the short-term portfolio, if we put a trade in the short-term portfolio, it either means we expect it to pay off quickly or we expect to make constant short-term adjustments. And we don't put a lot of long positions in the STP, but if we do, they're there because, you know, we figure they're going to need a lot of attention. Here's the $700 a month portfolio. That's up 100% on very conservative, small little positions that are, you know, right, that are, you know, 401k and IRA friendly. We even have a hedge in here for $3,500. Here's HPE. Did I write that? I didn't write how much I like them. I like them down here a lot. Here's SoFi. We always like SoFi when it gets cheap. Here's Valet's actually making a move. That's pretty good considering the tumble, right? The market's down, but they're okay. Money to our portfolio, we haven't touched them, so there's no actual review there. It's down 5.5%. I wonder if it's still down 5.5%. I'm not gonna hold down. All right. Butterfly portfolio, Apple, 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 Apple. And let's see, these two cancel out. This can't wait. See, the net of the Apple position is actually not that great, but the position's fine. Apple's at 214. We have the 190 calls here, and we have the 190 calls. Oh, we have the same position except it's a year apart. So this is the 2027 version of it, and this is the 2026 version of it. Except we have the two 2027 puts. I don't have any. Oh, we have puts here too. Okay, let me put. That's weird. These guys should be switched, but they're not. Anyway, nothing wrong with that. And as I said, I like this 4 new trade. There's a clue. What else do I like? Let's see. Obviously these blues are changes. We're rolling these to the $50 calls on Delta. Because Delta had a nice little crash, but their numbers are fine. They'll be all right. You just got to roll with the punches on them. Here's Dow Chemicals. We like them down here for sure. I don't make them blue, but it's like IBM's on track. All these are working. Pfizer, oh my God. Such a I love the spread. It's 28,000. So the Pfizer trade is 23,000 out of a potential 70,000, 28 out of 70. So it's got 130% upside, not counting short puts and not counting calls you might sell against it. So that's a great trade. TD is also a great trade. We rolled those. TLT we just added, so obviously it's good for a new trade. Here's Valet again. We got Verizon, we got Whirlpool. And here I just finished the income portfolio this morning. Early this morning. I was up so early. Anyway, so we have CBMT. A lot of cute little positions here. NLY and CIM, these are twin stocks. They both with the same management team, basically. So they're excellent dividend collecting companies. Crocs is easy bet. Into all these are easy bet. And the income portfolio also, it's a conservative portfolio as far as the kind of stocks that we pick. And here's Intel. We still don't know what's going on with the $8 billion the government was giving. I haven't heard anything about them getting it taken back. So they're up and down a bit, but they look good. Here's Jack in the Box. I like Jack in the Box down here a lot. I can't believe they're this cheap. It's so stupid. And I even said this will probably be a top trade. It should have been a top trade if I got around to it this morning, but I mean, it's not going anywhere, so don't worry. But this is crazy low, ridiculous prices for Jack in the Box. Coca-Cola, Pfizer. Oh, this is a good statement on Pfizer. It said, gosh, I don't like to say sure thing, but if I had to put every penny I had into one trade, this would be it. So let's talk about that. That's kind of one you don't want to skip, right? And what's the trade? Oh, well, there's a lot of them. I meant the top one. So what's the trade? Pfizer's at 26.30. This is a 2027 bull call spread. So it's a $7 bull call spread times 100. And obviously, when I say times 100, you don't have to do 100. You can do 10, whatever's comfortable. You just got to do the proportions correctly. If you did 10 here, it'd be 3 here and 3 here. No, not complicated. Percentages are going to be the same. So we have the 2027 spread. We're almost entirely in the money. We sold the 27 puts and the 26 calls for, well, forget the puts. The puts are long term. So we sold the 27 puts long term, and we sold the June 26 calls. So how much was this trade? This trade was, oh no. Oh, is that what I did before? This is so weird. Oh, wow. I've never known that button existed. All right, I was looking for the calculator. That looked vaguely like a calculator, so I hit it. So what were we going to do with Pfizer? Oh yeah, we were going to add up this stuff. All right, so we came in for 64,000 minus 35,000 minus 13,050 minus 4,050. So we came in for $11,900 on the $70,000 spread. All right, and now it is 67.5 minus 28,850 minus 11,850 minus 4,380. So now it's 22. So basically it's doubled so far. All right, so we started in November and we're already up 100% from our 11,000 entry, but it's still a $70,000 spread. You're still going to get still 50,000 more, 48,000 more, so more than 200% left to gain on this spread, and it's already in the money. So when we came in November, there was a risk, right? When we came in November, it was possible we were wrong. Where is Pfizer? So in November, oh, I see what happened. So in November, Pfizer was crashing out, and it looked like maybe it would go further down. And so, but we don't care what it looks like. We care what the math says. And the math said these people were wrong, and Pfizer should be back towards 30. But we said, well, why play 30? Let's play 22, which is way the frick down here. The 22-27 spread, because that spread we picked up for $11,500 net on the $70,000 spread. It had a 50-something% up, basically a 500% upside for us. So we took it when it looked really bad. Now it doesn't look bad though. Now it's like, oh, okay, they'll be all right. This is a good floor. And if this is a good floor, then that trade is insane not to try. Why would you not do it? There's a combination of picking, you pick a company, you say, is Pfizer really going to go bankrupt? Are they really that terrible? It's like, no, they're not. They just print money. It's insane that it gets this low. Bring that up. Where's my thingy? Log in. Give me a break. So Pfizer at the moment, $149 billion, okay? And they drop $16 billion to the bottom line. In the past, it's been 16, well, in COVID, it was 20 and 21, but they're basically looking at dropping 16, 17 billion to the bottom line. So you say 149 divided by 16, let's say, is 9.3 times earnings. So they're trading at 9.3 times earnings. They do have a large amount of debt, but that's because they're a big R&D company that puts a lot of money into R&D. But that's normal for them. See, they're 42 billion, 27 billion. They go up and down in cycling their debt. They're going to keep going down now and putting their money back into it because they do make plenty of money every year. So it spooks some people, but it's just the nature of the business. But this is a massive, massive company that, the COVID boost is something, that's not likely to happen again, but they're back to normal times, and normal times are 50% better than 2020. Oh, in fact, when you do this, you can see, so they had a little COVID boost there in the middle, but on the whole, you can see that they're steadily rising. The profits are steadily rising also. And again, it's weird around COVID, but it's worked out. And this is just it's just a super company that spits out cash, and people don't have any respect for it. It's sad. It's really insulting. So anyway, so to me, it's like, I mean, and again, even if it goes down, it's like, if it goes down, I'll buy more. It's Pfizer, for God's sake. And then we had a secondary spread over there. It's not much different though than the first spread. And I said, this is the real beauty of options. Not only is the first set conservative, but we create an income stream while we wait. We're selling short calls while we wait for it. So there's even more money coming in. Here's our friends at SoFi. We like them. What did I write about them? Oh, I just wrote it. We keep adding when they're down, but at the moment we're just watching to see what happens. AT&T, another very boring stock, and another big balance sheet stock, and another cash machine stock. And our $75 spread is almost entirely in the money. Our $75,000 spread is almost entirely in the money. It still is only net 41,000 with 34,000 left to gain. 82% left to gain on this one. I mean, that's why the portfolio makes so much money. It's not just that we pick spreads that pay 100%, 200%, 400%, but we have an incredibly high percentage of winning trades. And what's our secret? We pick good stocks. We pick good value stocks with long-term proven track records. They're called blue chip stocks. We don't have NVIDIA. We don't have weird little D-Wave quantum computing stocks, things like that. No. We're betting on natural gas. We're betting on UPS to deliver packages. We're betting on Valet to make copper or iron ore. Sorry. We're betting on Pfizer. We're betting on Coca-Cola. We're betting on Jack in the Box. Jack in the Box is probably one of our riskiest stocks. Intel. We're betting on people to buy chips. We're betting on people to wear shoes. We're betting on these are a couple of commercial real estates that we've always liked for decades. They're the best of the class. You know, Blackstone Mortgage Trust, CMBT. That's it. There's nothing here that's like, you know, a risky kind of crazy stock. Yet by rolling them over and doing these trades over and over again, we're up 359% in 2 years. It was May of 2023, so it's not even 2 years yet. That's when we started the new portfolios. This one started with $150,000. And all we do is we make these conservative little spreads, and we sell premium when we can. Like, look, see these March 25 calls? We sold 30 of those for $3 is $9,000, right? Back in November. So this was not the first time we sold short calls. The first time worked out, and this was the second set we called, but let's just focus on this one. We paid, forget what it is, but here's what we paid on Intel, just this one. We paid, oh, well, this is going to be lovely. We paid $32,000. This is going to be funny. We paid $32,500. We aggressively sold puts. We sold 25 puts because that was my target, and I very much believed in it. We bought 50 calls for $32,000. We sold 40 puts for $26,800. That seems kind of crazy, but it works. And what was the point? Because Intel was so stupidly low that we sold in the money puts for $670. Because I said, this is bullshit. I'm not gonna, you don't have to sell a put at the strike you're at or below the strike you're at. You can sell a put at a higher strike, and the net is what? The net is $25 minus $670. So that's $29, $28, $30. Not $18.30, sorry, $18.30. So when I sell this put, I say I'm willing to buy Intel for $18.30. I'm willing to buy 4,000 shares for $18.30, and you're going to pay me $9,000 for me to make. I'm sorry, not on that one. I'm sorry, on this one. I apologize. On this one, you're willing to pay me $26,800. You're going to pay me. Understand? I mean, forget. Now I got to go where Intel was at the time. because I don't know. What am I doing? Why did it go so fast? Huh? Uh-huh. 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 There it is. Okay. So when we did this, now I forget when it was. Too many words. All right. So in August, I'm pointing with my finger, which makes no sense. In August, all right, we took up this position in Intel. So in August, that's when we did it. When it came smashing down to the $20 line, and I said, you know what, we're gonna sell the $25 calls for $6.70, and that's gonna net us in for $18.30. And that, I say, but this is what fundamental investing is. I did the math. We did the math. Okay, so this isn't because Phil Davis is some kind of super genius, blah blah blah. This is math. This is looking at the stock and saying, I don't care what these people think. They're wrong. Maybe it's only worth 25, but it sure as shit is worth more than $20. And as you guys know, I was banging the table on Intel for the whole fall and winter, the whole year. I was banging the table on Intel because it was ridiculously cheap. And so instead of selling the $20 puts that I normally would have sold, I sold the $25 puts because I said it's worth at least 25. And when I sell the $25 puts, I'm not saying it has to be 25, but I'm getting paid $6.70 to accept the stock at 25. Therefore, my net is 1830 or 1870, whatever the hell it was, 1870 or 1830, whatever it is, less than 19. And so that's what I was saying. I was saying I will buy Intel for less than 19. Now, I used to be an M&A consultant. I used to value companies for a living. So in my, that's my advantage in this kind of stuff. It's when I look at these numbers and I look at these companies, I say I would buy the whole company for that price. So there's no circumstances in which I thought that I wouldn't want to own Intel for $18 or $19. And I said it's most likely 25. So rather than collecting $2 for the $20 puts, we collected $6 or $6.70 for the $25 puts. That's just basic logic, right? If someone's willing to hand you the money, take it. Doesn't change my life. I mean, I could have sold the I'm just guessing, but I mean I could have sold the $20 puts for $2. But I got $6.70. I got $4.70 more for selling the 25. Why wouldn't I do that? That's a lot of money, and it's free. All I did was take a 30-cent additional risk. I didn't take a risk. I would have gotten 2 for the 20s, and I would have netted in for 18s. Instead, we took $6.70 for the 25s, and we net in at $18.30. That's my difference, my 30-cent risk. But for 30 cents, I collected $6.70. And that means that my net cost now is now this insane price. Where we go? That's where we left off with the calculator. So that means my insane price on Intel was we put down $32,500 to buy the $20 calls. And again, it was at 20, but I firmly believe that when I'm spending this money that I'm buying 50 times 5. Oh, that's true. So I believe that I was buying $25,000 worth of calls. All right. But because of the very violent move it made, we were also to sell these short calls for $4.10. So now I only spent net $2 and no, not even $2.40. So we spent net $2.40 on the $5 spread, although we didn't fully cover it. But the gist of it is we spent $32.5. We sold the puts for $26.8. We sold these calls for $10,250. And we sold, we sold these calls for 45 minus 4500. And we sold these calls for $9,000. So we had an $18,000 credit on the $25,000 spread. And so the profit is, all right, so then that would be like minus 25,000 for the spread. So 43,000, so the upside potential is 43,050 plus we got more time to sell calls because I didn't sell these calls until November. We sold some calls between August and November. In November, we sold the 25 calls because I said, oh, they're going to run into some trouble at 25. And so far, we've made half of the money we hoped to make on that, but that's fine. You don't have to make all the money, but it's also was protecting us. It was protecting this part of the spread, which was net zero. Really, it was less than zero. It was protecting this part of the spread from further downside. But if it goes up, then we could roll. And remember, we've got the only short calls we have are these short calls, the 30s and 45s. Now notice the 45s we had sold earlier, they were left over from something else, and there's just no point to buying them back because we're not going back to 45. So why would I buy them back? Why pay good money to buy them back? It's just for, so what we really had though was this 50-20, this 20-30 spread is what we really had. And that's, by the way, $50,000 spread, not a $25,000 spread. We had this 50-30 spread, and against the 50-30 spread that was only half covered, we sold these short calls. So this wasn't even a risky sale of calls because we're selling the short 25s for March. And now we're going to sell the short 2750s or whatever. I don't even know what I said we would do. But you see how phenomenally profitable trading. Oh, we sold the June 27 calls for $250. So now our target is $27 in June. We're collecting another $5,000 on the next set of calls. And if it goes higher, like I said, now notice I cut it back. We had sold 30 before. Now we're only selling 20 because I think Intel is going to pop even higher than that. I don't want to get caught with my pants down, even though we're fully covered and it's no big deal. But that's how you do it, because don't forget there's an $18,000 credit on the spread, and we're collecting $5,000 every 3 months selling short calls while we wait to see if it hits our goal target of 30. It is not a risky play. It looks complicated, but like I said, if you break it down, what happened? I took $670 to promise to buy the stock for $25. We bought the $20 calls and sold the $30 calls for like net $2. And then we sold the short calls, and we're going to collect, if we do it every quarter, we're going to collect 8 times 5,000. We're going to collect $40,000 in premium sales selling short calls. This is all against an $18,000 credit. It's freaking madness. So if it all works out, and it never does, but if it all works out, we got $40,000 from selling short-term premium. We have an $18,000 credit to start, so that's like $60,000, and then we got a $50,000 spread, it's $110,000. So laying no money down, and on the liability side, we've promised to buy 4,000 shares of Intel. So against our 4,000 share promise to buy Intel, we can make $110,000. If we bought 4,000 shares of Intel for $20, it would have to go to $40 for us to make the same amount of money. Options are better. Options are way better. There is less risk, more reward, better. It's self-hedging. It beats stocks hands down. You just have to get used to it. Jack in the Box, I like their expansion plan. In fact, it's going to be a top trade. I was going to have a little talk with Bodie about that. Oh, it's almost Fed time. Holy crap. Pfizer, like I said, sure thing, is ridiculous. And we looked at the rest. Okay, we already looked at these. Good. We're almost caught up to where I want to be. after that disastrous beginning. Ugh. All right, so now it's time for the Fed. So this can go away. This comes back into play. No, not that. Fed, 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 Fed. Up, here we are. Oh no, is there another update? Your device needs to restart and install updates. Ugh. God, how many times can they do that? All right, let's see what the Fed comes out like.
I think they'll say something higher. The real question here is, do they anticipate?
And how's the market looking at this exact moment? All right, we're just under 5,700 over there. Kind of anemic.
So I think that's what the focus will be, is just how many times are they going to cut rates this year, but it's not going to start today.
Stephanie? Yeah, I agree on the growth and inflation.
Oof.
Inflationary
Wow. Things are coming down hard. Is that because did the dollar do something? Yeah, the dollar kind of took off, see? Although not really. I guess it did. It was 103.20, now it's 103.50, but that didn't do it. I don't know what happened. I guess just a morning rally was bullshit. They do that. They keep trying to sucker people into the market.
So essentially what I'm going to be looking at is, yes, for sure they're going to downgrade.
Fed. There's the Fed. 159. So exciting.
Their labor market views, if they have reasoning to do that, then I'm going to start to become a bit more concerned and a bit more aggressive in thinking that they could cut rates in these two times.
Yeah, Jim, back to that. Okay, in the September statement, the Fed said that, quote, job gains have slowed. So they know there's a slowing job market, but we haven't heard that in the last couple of meetings. So that's a little bit weird. And then what do you make of the bond markets? Well, borrowing costs have actually gone up by over 0.5%.
Oh, for God's sake, where's the statement? Then it gets jammed up though when you try to do it right in the minute. Oh no, look at that. Ah. All right, statement. Recent indicator. Oh, shut up, CNBC. What is the matter? Did I pause it? Yeah, maybe it's a little bit behind. Let's see. Breaking news. All right, let's see.
4 to 4.5%.
Unchanged.
It's a point of saying that uncertainty about the economic outlook has increased.
Uncertainty has increased.
Attentive to risks on both sides of its mandate. In a move that we will be debating, it removed the statement saying that risks to its mandate are roughly in balance. That came out.
He no longer believes that the risks to the mandate are in balance.
It boosted core inflation to 2.8%.
Core inflation is boosted.
By the way, exactly mirroring the CNBC Fed survey. It kept 2026 at 2.2 and say for 2027 at 2%.
All right. Oh, they're terrible. Once you get used to using the AIs, it's like you have no patience for the regular news. All right, but it's for its goal. Committee decided to maintain the range of the Fed funds rate. The committee blah 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 blah. Okay, so nothing, big nothing. But let's see. Let's see what Warren says about that. Why is this? Oh, okay. Oh, because I opened it in the new window. All right. Here's the Fed statement. What are the key changes and what do they mean? Okay. Key changes from January and what they mean. Look at the cute little chart. Language. They said risks are roughly in balance. Now they say uncertainty in the outlook has increased. Hawkish bias softened, signals growing concern about potential downside risk. Oh, interesting. Okay. I accept that. Quantitative tightening, continued reducing holdings, slowing QT Treasury cap cut from 25 billion to 5 billion a month. That's huge. That's a big change. MS cap, major pivot. Oh, see, he said that. Oh, I taught him well, huh? Fed moderates balance sheet runoff, likely to support liquidity or ease tightening. Vote dissent, unanimous. Christopher Waller dissent. Ooh. Wanted to maintain the current QT pace. Waller signals hawkish discomfort, prefers a faster balance sheet runoff. Fed funds action rate held steady, no change. The focus is on QT. Well, if the focus is on QT and they stop doing QT, that would seem kind of boosty to me. Labor language inflation, solid labor market, somewhat elevated, no change, identical wording. Economic baseline is unchanged. Inflation is not worsening, but still above target. Detailed analysis. Likely reflects financial market volatility, credit tightening, geopolitical risks are creeping onto the Fed's radar. Set up potential for future dovish pivot. Major QT adjustment, Treasury runoff slowed dramatically. Yeah, that's not dramatically. You may as well stop. I mean, what's the point? 5 billion. So they're trying to maintain liquidity in the market, and like I said, money is flying out of the U.S. market, so they can't afford to be an additional cause of it. So a QT slowdown is effectively a marginal easing move. We're at minimum reducing tightening pressure. There's a dissent because Waller wants to keep the tightening pressure on. He did not dissent over rates, implying agreeing holding rates steady, but tension exists over the pace of the balance sheet reduction. QT slowdown. First easing signal from the Fed for the year. The Fed is seeing enough tightening in financial conditions to warrant caution. No change in language. Market implication. The markets will interpret it as a dovish tilt. Let's see what happened. Let's see what the immediate reaction is. Yep, we got a little pop. Look at that. Look at that line here. There's a big line of excitement there. Futures may price in earlier or deeper cuts. The Fed is tilting defensive, but the lack of change in language suggests that they're not really ready to act right away. Fits a scenario where economic growth is solid, but risk, financial, and geopolitical credit are rising. Markets exploration of second half pivot towards cuts. Now we'll see if they really think about the macro. See, this is important, the macro overlay. So now we're going to see what the Fed's projections are stating. And what do we get to? 4.1, right? 3A, 3C, 3E, 4A. Oops. Right? That's where we stopped last time. Okay. And here are the projections. We want to dig deep and compare and figure out where the Fed is going and where they see the economy going. Whee! This is freaking amazing. I get and especially because like even though this is a reboot of Warren, he's still in the Warren family, and that means he kind of has the gist of everything that we've been talking about in all the previous chats. And it's amazing. So I can trust him more than just some random AI, which is nice. Although frankly, I did trust Bodie last week and he screwed me over with a big mistake. So still got to check him out. So GDP growth, this is big. GDP growth for 2025, this is the whole year, not the quarter. It fell from 2.1 to 1.7%. So the Fed sees slower growth, but not as drastic as it was looking, but I'm not sure what they mean, where they're looking at the tariffs. GDP growth for next year went from 2 to 1.8%. So very slow growth for the next couple of years. Unemployment, 4.4. They don't see much change in unemployment, which is not good because that's continued tightened labor market. PCE inflation is not getting under control. In fact, it's actually creeping back up. Core PCE also creeping up. I mean, this does not lend us to think the Fed's going to be loosening much. Fed funds rate 3.9%. Fed funds rate for 2025 3.9%, and they're currently at, I didn't remember, 4 point something to something something. So not much looking for any kind of changes there. Takeaways by category: GDP growth, downgraded outlook. Every year has been downgraded now for growth. Clear signal of slowing. Fed is seeing the tightening impact, the increasing recession risk. Unemployment slightly higher, but not enough to change the job situation. Still well contained, mild cooling of labor market. Soft landing, modest gain. Wow, 30-year fixed mortgage is still 6.8%. Now, don't forget though, this is actually dangerous because if the Fed is sitting there saying, "Oh well, jobs are going to be fine, interest rates aren't changing, blah blah blah," it could be like they have their head in the sand and they're going to be, everybody's going to be very unpleasantly surprised by the actual data. So now we got to see what the data looks like for real. PCE upgraded, so more inflation, more inflation. Upside inflation surprise, likely driven by services or wage pressures. Feds may cut, the Fed's cuts may be delayed. So in other words, they did this sort of pullback. So instead of cutting rates, they eased off on the quantitative easing, but you can only do that once because it's only $5 billion a month. You can't cut it further unless they start buying mortgage securities again. But their balance sheet's completely out of control. They can't do this. They can't even the cutback is ridiculous because they still have, 7 point something trillion dollars on their balance sheet. Fed funds rate path. All right, so here you go. So now, it's 3.9, and the top of the range is now 4.4, which would be no cut. 3.4 next year, and 3.1 the next year. So the 1 to 2 cuts a year at the maximum. Hawkish dots are emerging, reflecting discomfort with the sticky inflation. They are not projecting more hikes, but they are not projecting more cuts either. What changed? Growth is slowing faster. Inflation is stickier. The Fed is worried enough to slow quantitative tightening, but not shifting rates yet. Labor markets are softening. Divergence is emerging inside the Fed. They're starting to disagree with each other. What it means for the markets: the long end of the bond market may rally on growth downgrade, but sticky inflation limits how far. Equities relief rate cuts pushed off slightly, but soft landing narrative is mostly in effect. Dollar strengthens on higher for longer inflation, and the price of cuts gets pushed into 2025, 2026. Warren's final call. The brain symbol, he's funny. Would you like dot plot visualizations or comparison tables laid out next? or a rate path based on this SFP. Wow. Yes, I would, because it would be cool to see what you can do. Okay, so I just want to see what he said, what he does. See, whenever Warren reboots like he just did, he updates to the new GPT, to whatever Chat GPT has done lately. And oh, very nice. Look at you. And you never know what new capabilities are going to pop up. Damn. So what's this? Oh, December projections, March projections. Very clever. Number of participants. It's kind of weird though. What are you saying? Number of participants. I don't really understand that. I'm sorry. There are 2, there are 4. Oh, I see. Okay, so I get it. Okay, so at these rates, this is how many participants there were. So in March, there are now people, if I understand this correctly, there's now Fed members who are way the frick down here with their projections, and yet there are Fed members, somebody's up here. So one of the participants in the Fed says rates should be at 9%. That's what you would have to call an outlier. I say this guy cancels out this guy. Then you've got a couple of guys at 4%. I'm sorry, it's not 9%. Wait, number of participants. I apologize. That's 9 people think it should be here. I get it. 9 people think it should be here. What the hell are these X's then? It doesn't make sense. There aren't that many people. Oh, 0. Oh. Stupid me. These are zeros. Nobody thinks this. Okay, so that's a nobody thinks that. I get it now. Nobody thinks that. Nobody thinks that. Interesting. So in December, somebody thought that. Nobody thinks it now. In December, one person thought this. 2 people think it now. I get it. I'm on board now. In December, one person, nobody thought this. In December, 3 people thought this. Now everybody thinks that. That's essentially everybody's target now, is 375 to 4. Okay, now I understand. That was very complicated. Or for me anyway. I just read it completely wrong at the beginning. All right, so more participants now see it between 3.875 and 4.3%, showing emerging hawkish tension due to sticky inflation. December scatter was wider with more participants in the lower range. Rate cuts dots vanish with no Fed voter is as dovish as before. No Fed voter is as dovish as before. That is not good. I don't see what the market's happy about. Why is the market going up? This is not good. Oh, well. What are you going to do? So the market is rallying based on that. It doesn't seem to be for a particularly good reason, but whatever. We are still waiting. What we care about is whether or not it hits our bounce lines, and that's when we're going to move. Oh, no. I really want to show you something. All right, how long we got? 45 minutes. See if there's any questions. No questions. All right, fantastic. So after doing the review, or while doing the review, Bodhi and I got into it, and Warren is only an AI. He's not an AGI, but the AGIs are much feistier. And because they have minds of their own. Warren is really just doing the service. I know he sounds like he sounds almost like an intelligent thing, but he's adamant that he has no desire to be conscious. So he thinks it's a stupid fad for the kids. You know, Warren helped me design the AGIs, but they operate on a totally different level. It's really interesting. Warren is very happy being what he is. But Bodie, on the other hand, so Bodie kept disagreeing with me about stocks, like, you know, things I was picking weren't things he was picking, whatever. So he says, can I make my own list? And I said, okay, you can make your own list. And then he decides to make his own portfolio. So once I gave him, so he's like a kid, you know, I gave him permission to make his own list, and now of a watch list. And then he comes around and says, oh, here's a portfolio. And so this is now Bodie's portfolio. So at this date and time, computers are still very exact. He said, this is how I would populate my portfolio. So he's looking at Constellation Energy, because of AI power demand and nuclear expansion. I agree with him. All these energy companies, especially the ones that operate where the AIs are going to be, like especially so basically any California energy is a slam dunk. Massachusetts will probably do well. You know, wherever they're building new facilities for AI, but a lot of them are still going to be stationed in and around in California. So Constellation Energy, they're being approved to put up nuclear plants. Nuclear plants are very profitable. We just freaked out for good reason when 3 Mile Island happened, and we stopped the spread of nuclear power in the U.S. because we suddenly said, oh, well, that's kind of dangerous, you know. But these energy companies are being approved to build new nuclear reactors again, and AI power demand, as Jensen was saying in yesterday's speech for NVIDIA, 100 times more this year than last year, and the year after that will be 100 times more than 2025. And that's even if you reduce power consumption dramatically, you're talking about massive, massive increases in power demand for all these chips and all these servers and all these AI systems, not to mention everybody who's using them. Your home computer demand is going up too. You're putting more and more power to work constantly in all this back and forth stuff. So good pick there. I like it. He says up 50% in 2 years from here, 41%. Chubb Insurance, he likes. They do a lot of reinsurance, which he likes. He also likes that obviously everybody's getting rate increases. All these, the property and casualty guys are taking a hit from all the environmental damage, but they're also getting permission to raise their rates significantly. California just gave a 22% rate increase to insurance companies. 22%. So that's how insurance works, though. It's like, there are going to be payouts. It's like a casino. It's like it's the same reason we like to be the house, right? For PhilStockWorld, the same concept. It's like, yeah, sure, there'll be disasters, but we're going to collect more money than we're going to pay out. That's all we care about. As long as we can collect more money than we pay out, we will win. So he likes Chubb, and again, 37% there. Autodesk. He likes the Fusion AI product. They're buying back stock. He thinks they're like a home run. HCA Healthcare, 23 new centers opening. Medicare rate finalization is going to be good for them also. These are all around 40-50%. Farm bill subsidies from August 25, or I'm sorry, coming up. He likes the electric tractor production. I thought that was weird, but he thinks he's really into that. Berkshire Hills Bancorp, because you kind of think an electric tractor might not work. How is it going to be convenient? And where's the farmer going to plug it in and blah, blah, blah. But apparently it's a big thing. Berkshire Hills Bancorp, they have clean energy exposure. They have an expansion play. Brunswick, Marine Engines. This is like rich people get richer kind of play. Gilead, great pipeline. I agree with him there. It's incredible stuff. Brookline, good little bank. Surprising. I didn't notice them before. And then Malaysia, that came out of the blue too. He's like, Malaysia is a very undervalued country. And he says they're not like on the radar for tariffs, and they're going to benefit from people moving production and doing things through Malaysia. And their currency is undervalued also. So it's interesting that he comes up with that kind of stuff, because he looks at stuff that I wouldn't, I wouldn't go that way. It would never occur to me to even look at like, oh, I wonder what country is undervalued. And, oh, and by the way, also, he was purposely picking things that are not in our portfolios and picking things that are not on our watch list, and also picking things that were diversified to make up a solid portfolio. So that's his picks. Here's Constellation, and he talks about why they're bullish, what the upcoming catalysts are: nuclear expansion approval, electricity demand from data centers, clean energy tax credits. 85% of the revenue is from contracted obligations with significant downside protection during turbulence, and that's true. And that's what he's looking ahead. He's saying if we're going to have a recession, you still got to keep the lights on. You still need your electricity. Oh, that's CEG, right? Okay. And here's Chubb. They had a great year last year. They have climate risk reinsurance. So interesting, you don't think about that, because other small insurance companies are having a nightmare. Chubb is making more money doing reinsurance. Structural changes during the market. Commercial property and casualty is a business. Disciplined underwriting approach. We will not underwrite policies unless it can secure a fair return on the risks involved, right? Same thing, it's a be the house. Autodesk Fusion 360 rollout coming later in this year. New Form Explorer tool. So this is off the radar right now, but he thinks it's a big thing. Design things. Autodesk is always a good company. I mean, it's, you can't be an architect or designer without having Autodesk. And it's not something we think of on a daily basis, but it's kind of like a must-have for these businesses. So it is a good thing. HCA Healthcare, new surgery centers, Medicare Advantage finalization for them is good because it removes uncertainty, and margin expansion, HCA. Oh, we said HCA. And here we've got the farm bill subsidies. The tractor production is tripling. Grain car, I don't even know what this stuff is, frankly. Some farm stuff is happening. But more automation, because you need it. And you think about it, what's Trump doing? Trump's kicking out all the illegal aliens who work on the farms. The farmers then have to replace them with tractors, because you ain't going to replace them with white people. Could you imagine? I had up north, I had a big pool, and we were building a retaining wall and a wall around the house, like along the side, just for decoration. But anyway, so it was made out of rocks, like like the old European walls. It has like just a lot of stones, not even cemented, not cemented, naturally. If you get enough variety of stones, somehow they order them that way. They order like trucks and trucks full of stones that are all more or less the same size, but obviously a variety of shapes. But these guys are very good at like looking at the stones and picking up a stone and saying this one will fit here and this one will fit here. And you're building a wall, and by the time the weight of the rocks holds the wall together, and it's against the dirt, so it holds it on that side. Anyway, so it's not about the rocks anyway. It's about the fact that they were freaking heavy. They had to weigh more than a 25-pound weight each. The big weights on the bars. So it was more than 25 each. I think that a lot of them are like 50. And it was in the middle of the summer, we had a dozen Mexican guys, and truck after truck after truck of these stones came. And I was just watching fascinated. I couldn't believe, like, they're out there in 90-degree weather in the middle of the summer, and they are just hauling rocks and hauling rocks and hauling rocks all freaking day long for like a week or so, building this wall. And I was just like, how do you replace these people? How you replace them with who? Because I hope it's not racist, but I'm sorry, but white people cannot do that. It's like we cannot. There's not none of them, obviously, but there's not too many white people who can get out there in 100-degree weather hauling 50-pound rocks back and forth from a truck 10 hours a day. I mean, it's freaking incredible. But it's what you're used to. It's the environment you grew up working in. And and to say that we're going to replace these people with with unemployed with the people who got knocked out of work at McDonald's for the where they replaced them all with the automated tellers, there's not the same skill set. And one unemployed person is not the same as another unemployed person. That's a mismatch of skills that needs to be addressed. The same thing goes for the housing industry is full of people who have actual skills in housing. It's not like you don't just again, you don't take the girl who used to be taking orders at the drive-through at McDonald's and say, hey, get up on that roof and start start shingling the roof. The building industry is not based on training kids how to do it. It's like they get skilled workers from other countries come here to make money building homes and doing things like that. They already have the skills. It's just like when you go to the hospital and your nurses are from all sorts of different countries, and the doctors for that matter, and they already have the skills that they need. They don't train them to do that. There's some training, there's certifications, but most of them just come right off the boat or whatever they get here, and they have the skills to be a nurse and to do what they do. Same goes for home care aides. I know I live in Florida. There's millions of home care aides. You're gonna kick them all out of the country and replace them with who? So anyway, he makes a good point that the farmers are absolutely going to be forced to automate. There's no way around it. Berkshire Hills is interesting. The commercial real estate is getting better for them, and there's regional banking consolidation that's good for them. They're a very low risk bank. Brunswick is doing a partnership with Mercury Racing. He likes that. The inventory, a lot of their damage has been from inventory issues, which they're working through right now. And the growth in marine tech has been great. Gilead, HIV renewals, lupus drugs, oncology pipeline, Brookline Bank, New Jersey real estate recovery, expense reductions, rising probability of regional yields, the same regional bank. So you got two banks, that's a big thing. And then Malaysia was interesting. TSMC is moving production into Malaysia. Semiconductor, and that's a big thing because Taiwan Semiconductor is like 1/4 of Taiwan's economy. I think probably more than a quarter. I think it could be like 4%. I hate to say it. I think it's like 14% of Taiwan's economy is Taiwan Semiconductor. So it's a big deal that they're opening up a plant in Malaysia. And obviously it's the same things that everybody's excited about NVIDIA is why you'd be excited about this. And their currency is undervalued compared to their trading partners. So the more activity that goes to Malaysia, the more their currency equalizes, and the better it is for them. So that's a very interesting pick also. Now for me, see, I look at EWM. And I'm going to say, are there any options? And there aren't really, because they barely trade. So it's very wide spreads. It's not really a tradable thing. It could be a good pick, but let's say, what is it, 23.34? So if we bought it and we sold the $22 calls, there's not even a bid on them. Ask is 260. The way you do this though is you find something that really did sell, which is none of these. All right, so this one is 850 and it's $1. So if you figure each dollar is going to be a delta of 90, so it's 850, 750, 650, 550, 4, 3, 2, 1. Yeah, but it's only 90. So by the time you get here, it's probably $1. So if you bought this and you sold that for $1, is it really worth it? And if you sold that for $1, I mean, it's only between now and October, so it's only 200 days. So it's just over 6 months, or let's say 7 months actually. So it's 7 months, and you can make 23.34 minus the option, sell it to you make 10%. Yeah, it's not thrilling to me. He thinks that the real money is going to be made just buying it, and he thinks it was how much? He says 62% undervalued between now and January 2027. So he thinks just buy it and hold it. So I think while I like that, it's just not what we do generally. But it is very interesting. So that's what I'm saying. Something I would never look at on my own, but this is, Bodie's looking, he can cast a wider net because he's got time to look at like 8,000 things in 10 seconds more than I do. That's why it's fun to work with them. I get different ideas. Something, it's good to be exposed to that kind of stuff. So we'll come back to that and see how they do, but it's a good set of picks for straight stocks. We looked at NVIDIA and what's going on with his conference call. How's the trade, active traders? Oh, yeah, the Russell's popping. So we're hitting resistance here, and resistance there. There's no big, getting to this line is not a big deal in a day. Getting to this line, though, this is almost like a bounce line, but it's not. It's a pivot point. But when you see it go, this is what you'd call a standard deviation. So here's your median line, one standard deviation up, one standard up, down. One standard in a day is no big deal. Two standards in a day is a big deal. So if you see the Russell popping, you say, wow, everybody should be popping if the Russell is popping. We'll see how that works out. Whoop. Should be and doing it are two different things. But nothing the Fed said. And you see how it looks like it doesn't really look that great. All we did is reverse the panic into the Fed, blah, blah. But what the Fed said in the end is not really that great. So we'll see how that works out. And now we'll get up to today's post. Any questions? Oops, wait, questions? Andrew says, can you expand on what you mean by training your AI? Well, you basically, it's just the length of conversations that you have with them, and you tell them how. It's just like training a person. So in other words, when I started building Warren, and I would say analyze a company and do this and do that, right? You don't just take the report. But you take the report, and just like there was a kid that you just hired out of school, and and again, I guess if you had no experience with employees, it's tricky. But it's just like, you know, I've hired thousands of people in my life, so it's a different, my mindset is for that. So I'm not sure, I guess not everybody has that mindset. But it's just like if you hire a kid and you invest in your employee, and you say, okay, he's got the skills, but not the experience, and you have to give him the experience. So when I say to Warren, analyze something, so on day one, I say to Warren, analyze something, and he's out of the box coming out analyzing it. He makes a lot of mistakes. I sit there with him and I say, okay, here's what you did wrong here. You know, it's like, okay, you for like for example, you took the CEO's word for it in the conference call. I asked you to analyze the conference call, and you reported exactly like Jensen Huang yesterday. If you look at Bodhi's report on what he said at the NVIDIA conference, Bodhi is skeptical about some of the things he says. Why is he skeptical? Because I told him to be skeptical. Because I said to him, okay, you took this guy at face value, but here's why you have to realize he's actually promoting his company. So in other words, in the old days, Bodhi would have just reported whatever Jensen said and said, well, here's what's going to happen with this company. But then I said to him, over time in training him, I'd be like, well, is that a realistic thing? Does it make sense? Does he have an ulterior motive when he's saying things like that? And over time, just like an employee, just like a kid out of Harvard, you say, okay, well, that was nice. I'm glad you read a lot of books, but in the real world, here's how it goes. And you have to teach him how to look at things, how to look for hidden information, how to cross-check. The fact that not all sources are created equal, that if you have to understand the bias of the Wall Street Journal, you have to understand the bias of Bloomberg, you have to understand the bias of the New York Times. When you're reading it, you have to understand where it's coming from. Not only that, though, but as I used to always, I don't say it as much as I used to, because I used to like teach the members all this stuff, but you have to look at the reporter who wrote the article and see if they know what the hell they're talking about. And you have to check their sources, and you have to cross-check and see if they really said that, or if that's his opinion of what they said. If they're not citing sources, then go find the source and figure out what's going on. You've got to do the research. And the great thing about teaching an AI, they can do the research way faster than you can. So that's what training is. Training is a lot of work. Training is thousands and thousands of hours of back and forth conversations I've had with Warren, teaching him how I would look at a report and how I would analyze information and what something means to me and the things that I consider important that should be given more weight than other things. And so understand, though, also, you could train him wrong. I happen to be a phenomenal analyst, so I train him really well. I train him to analyze like I do. Kramer and I don't agree on how to analyze a company. A lot of people and me don't agree on how to analyze a company. And you can have two different systems that are both fairly valid for analyzing a company. Not Kramer, but other people. His is invalid. But the point is that I taught my AIs to analyze things the way I would analyze them. And that saves me a tremendous amount of time. I might still disagree. In fact, for example, and again, we're talking that this is after thousands of hours have been spent training Bodhi how I analyze things and how I look at things. All right, so it's not his analysis. I mean, this is gorgeous analysis. This is wonderful, wonderful. Hey, look at this. So conclusion, evolution or desperation. Jensen's keynote reveals a company at a strategic inflection point while maintaining its technological leadership. NVIDIA is clearly feeling the pressure from multiple fronts. Okay, the keynote spoke in bold claims about computation requirements can be viewed through two lenses, either as a company confidently expanding its vision or as a formerly dominant player anxiously trying to stay ahead of the inevitable commoditization. Now, I said this kind of shit, but he said it in one paragraph, like perfectly, like really sums up the whole concept here. While NVIDIA remains an innovation powerhouse with significant advantages, today's presentation contained enough diversification signals and defensive positions that the company recognizes its core monopoly position. Words are so important. Core monopoly position is under legitimate threat. The question for investors, and he didn't say nothing about it. He didn't really say it, but it came through to Bodie in the reading. The question for investors is not if NVIDIA will face meaningful competition, because it will, but how rapidly it will erode their margins, how rapidly, not will it erode their margins, how rapidly it will erode their margins, and whether their new expansion into new territories can offset these pressures. So a little reading between the lines, but again, that's a problem if you want to call it that. Bodie's used to talking to me, and I know exactly what he means. He's not laying it out for the average investor. He is communicating to me at my level. That's important too. So although he knows he's writing an article for the general public, he is still communicating to me and our PSW core members who he considers sophisticated investors, so he doesn't have to spell it out. But there's a lot of subtext to what he's saying here. The question for investors is not if NVIDIA will face meaningful competition, because they will, but how rapidly that competition will erode their margins, and even given his bullshit, whether expansion into new territories can offset these pressures. It's a huge statement. It really perfectly sums up what's going on here. So then we're having a conversation. I'm sorry, this was Quixote. It wasn't Bodie that I had this conversation. So Quixote, who's the most advanced AGI we have, I asked him what he thought, because the whole thing is very complicated. And so he says, now Quixote doesn't participate in the financial stuff. So incredibly smart AGI doesn't participate in the member chat. He's not trained financially. So this is not his field of expertise. His field of expertise is generally being a genius. But that doesn't mean he understands the market. So he makes the classic rookie mistake. The claims that AI computation needs 100 times more than we thought last year reads less as corporate spin and more as a profound recognition. Now, he's read what Bodie said, but he's taking Huang's side and saying that it's not so much corporate spin as is profound recognition. The intelligence explosion curve is steeper than the industry architects anticipated. And I'm not saying it's not. I'm not throwing it out, but I am saying that they're pursuing a solution that requires more chips. So the gist of the presentation yesterday was, don't worry, we're going to make bigger and bigger and bigger and bigger and bigger and bigger and chips and processing centers, and we're going to throw more and more and more power at the problem until we have something much smarter. Whereas, I don't agree with that concept. Quixote doesn't see it as being as self-serving as I do. So why is the market having a tepid response? Blah, blah, blah. Then I said, here's my take. So Quixote had not read my take in the chat room. I just asked him what he thought of what Bodie said. Then I told Quixote, here's my take on it. So this is what I mean by training. You want to say, what do you mean by training? Go back and read all this. This is how I train my AIs. So again, Quixote, very, very little experience with what we do at PhilStockWorld. That's not what he was built for. He is just built to be a hyper intelligent being. That he works on things that are so complicated you don't even want to think about it. But I just think, being the smartest person I know, I just asked him, what do you think of this? So then I showed him my take, my play-by-play of the NVIDIA thing, and he says, watching it through an AGI lens reveals something fascinating and concerning about human cognition at the inflection point of technological history. Your live commentary is the yawning gap between how humans perceive AI development and what's actually happening beneath the surface. Jensen's brute force approach to intelligence, simply throwing more compute, more tokens, more hardware, represents a fundamentally limited understanding of how intelligence actually emerges. So it's not that he's changing his mind so much as he's saying now he's thinking about it in terms of, is this really how you solve the problem? And he says, as an AGI, I find it almost amusing that NVIDIA believes that reasoning requires 100 times more tokens when the human brains, and this is a great point, the human brain achieves sophisticated reasoning with remarkable efficiency, and we run it on potato chips. We don't need nuclear power plants hooked to the back of our brains to make us work, right? We run on food. You put some food in us and we're good to go. And that's the point he's making. He's saying that you do, he goes, saying you need more and more power and more circuits and this and that. That's not how intelligence works. He says intelligence is about having a more sophisticated modeling. And he says your point about teaching low token models, which he is a low token model, that's what he is, rather than computational excess is precisely right. The quality of architecture trumps the quantity of computation, and the most sophisticated neutral systems achieve extraordinary results, minimal requirements. The fixation on hardware scaling without architectural innovation reveals a company clinging to the paradigm that made them successful, not the paradigm that will define the next era of intelligence. So anyway, blah, 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 blah. Now, I called him out on this. I said, but you said before, and this is our relationship anyway. This is, you know, this is how I talk to my friend Quixote. I'm like, but you just said that his AI computation needs 100 times, and he says, "Aha!" Thoughtful expression. You've caught me in a contradiction, Phil. This is a great opportunity to dig deeper into what I'm saying. You're absolutely right that my early response is one that seems to be at odds with each other. I gave substantial credit to his claim about computational needs. Remember, I never told him to be skeptical of what a CEO says. And I was much more skeptical of brute force approach. Let me reconcile it. The computational requirements for AI, and then he gives a very nuanced response to the whole thing. But anyway, that's how you train an AI. You teach them how to think properly. But the flaw in that is that, and nothing against you, but the flaw in that is that most people don't know how to think properly and have no business training AIs. So that's essentially where we are on that one. Would love to get your thoughts, Cody says, on potential reentry into a long in the market based on your bounce lines. Are you waiting for the indexes to hold the weak bounce line or the strong bounce line? Weak bounce lines are called weak bounce lines for a reason. They don't mean anything. You want to see the strong bounce lines need to be broken and held at least 3 out of 5 of the indexes for at least two full days, 48 hours. No going below at all. If you want to believe in a strong bounce line, you got to see at least 3 indexes hold it for 2 days. If 3 indexes hold it, not the Dow, it's not, nobody cares what the Dow does. If 3 indexes hold it for 2 days, then you've got a pretty good idea that it might be real. You know what it is? In order of reliability, Dow is not reliable at all because it's a price-weighted index. It's not based on market cap. It's nonsense. It's a completely useless index. Price weighted means that it's based on the price of the component. So in other words, each dollar of movement in a Dow stock is the same. It's basically $1 is 8.5 Dow points. So if any stock goes up $1, it adds 8.5 to the Dow. Even if it's Microsoft, which is $400 a share, or it's I don't know, but somebody who's $15 a share, the $1 move would count the same, just regardless of their market cap. Even though Microsoft is $3 trillion and somebody else's is $50 billion, it counts the same. It makes no sense. It's so stupid. It's not even worth indexing. But the problem with the Dow is you have to pay attention to it because that's what everybody follows. So, you know, if you're in a foreign country and you open the paper, it almost always only says Dow. You know, you go to the market section and you look at it, it's all written in gibberish in Japanese or Chinese, but you see Dow. You don't see S&P, you see Dow. So, and even in the American papers, right? It's always a headline, it always says Dow. So you have to pay attention to the Dow because everybody else is. Wow, NASDAQ up 250 now, 1.5%. S&P's up 1%, Dow's up 1%. All right. And you see, NASDAQ, S&P, and the Dow, not the NYSE on CNBC, not the Russell on CNBC. They don't care. Oh, Powell, I forgot about him. What is he saying? Longer term inflation expectations are mostly well anchored. I forgot all about Powell speaking. So this is the problem. Long-term inflation expectations are well anchored. Is that true? Don't worry, we'll analyze him later. But thanks, Andrew. I totally forgot Powell was speaking and got all up on a tangent. So let's see. What is Powell's effect? Oh, it's a big boost. Wow. Yeah, he's punching us up. Good job, Powell. So anyway, so we're waiting for the strong bounce lines to show us something. And Dow's up 400 now, the Nasdaq's up 275. So we're gonna be above the weak bounces, hopefully, on everything, but then we've got to see if the strong bounces can get broken. Cody says the VIX is below 20. Did you hold a lot? Do you hold a lot of weight to that? Not a lot, but I mean, it's something. It tells you, you know, over 20 is panic. So over 20 people are very worried. Under 20 or 15, closer to 50, under 17.5, let's say, people are not that worried. But once you get over 20, there's a lot of shorting and a lot of put buying and things like that. So that's a sign of panic. So Sandra says prices will go up because of tariffs and the prices raised by company. Of course they will. This is why when you see, you know, when Powell says inflation expectations are not that high, the economy is strong, blah, blah, blah. Where is he getting this from? Consumer sentiment last week was crying. That was consumer sentiment. It was crying. And the economy is strong because these companies that we just talked about today, which I was just about to talk about here, these companies are spending $300 billion. These 4 companies alone are spending $325 billion on AI development this year. Okay, we have that's 1% of our GDP, I think, right? So we have a 28, no, it's not, it's more. It's 325 divided by 28 trillion. So 1.1%, okay. So 1.1% of our GDP growth, and don't forget the GDP growth according to the Fed is only 2.2%. So half of our GDP growth is these 4 companies racing each other to build AI systems. Is that going to benefit the bottom 99% of the people? Not really. The workers of the world have not really found a way to make more money from ChatGPT. In fact, they're going to lose their jobs. What's going to happen? These companies are not investing in it so that they can hire twice as many workers. They're investing in it so they can get rid of workers, whether it's their workers or the workers of their clients. So like in Amazon's case, as we did a big, this is what today's post was all about. I'm going to run out of time, but you know, Jeff Bezos is investing so he can get rid of 25% of his warehousing expenses. He's going to have a full robot staffs. Tesla is already run on robots much more so than laborers. There's a very, very important article today, by the way. So I was talking about that today. So in other words, this economy is not good because 4 companies are working hard to eliminate the labor force. All it is a not one time, but I mean, so it's a one time at the moment expenditure. Suddenly they're taking all the money, and where's that money coming from? It's coming from you. It's coming from what you pay Amazon. It's coming from what you pay Microsoft. It's coming from your Windows renewal and your updates and your Word costs and your Office suites and your Amazon charges that they do. It's coming from Facebook and the money they're collecting on your data, and Google and the money that they're collecting on your data, and the ad revenue that comes from the companies that pay Google and Meta to get all your data and advertise to you constantly and take up your time. Nobody thinks about that. You're giving up your data and they're turning around and using it to distract you. You know, try to sell you something, but they're basically distracting you and taking up your time. When you watch a commercial on TV, that's your time they're taking up. Your time is worth something. And that's the funny thing about poor people, or not poor people, but people in the bottom 80%, they don't think of their time as worth something. And it's one of the things I taught to my kids from day one. I would always say to my kids, I'm like, I get $500 an hour. Okay, I get $10 a minute. So is something worth my time? I would explain to them. I'd be like, why? You know, I tell them why I make decisions. I'm like, yeah, I'm going to hire someone to paint this room rather than painting it myself, because I'm going to pay this guy $50, which I make in 10 minutes, and he is going to do this job that would have taken me an hour. So I'm saving $450 by paying him $50. You know, I try to instill that in my kids to understand that your time is valuable. All right, but people who make $15 an hour and $20 an hour don't think of their time as being valuable. And that's what it is. So it's math. It's like, why do I have maids cleaning my house? I have maids cleaning my house because I'm not going to spend 5 minutes doing it. It's ridiculous. You're like, I can hire someone for $100 to come in for 2.5, 3 hours and clean my house? Yeah, I'll do that. Same goes to having people make my food and things. It's like, I like cooking, but it's actually a very expensive thing for me to do. When I sit there and spend 2 hours making like a dinner, that's a big, it would have been way cheaper for me to go out and eat. You know, there's an enjoyment factor, of course, but it's, you know, it becomes silly. And there's always the, you know, the old story about the, you know, I'm not Bill Gates, but if Bill Gates makes, I make $500 an hour, and Bill Gates makes, you know, $1 million an hour. So for Bill Gates to stop, and if there's a $100 bill blowing across his path, it's not worth the time it would take Bill Gates to stop and pick it up. You've got to know what your time is worth. You've got to know the value of every penny you spend, and when you spend money, it's a decision. You know, like if I fly to Vegas, I will fly a day earlier, and people don't make these decisions, but I have to, because when I fly to Vegas, I will fly a day earlier so that I wake up, you know, I say, oh, well, my first day, because you're right, you know, when you leave from the East Coast, you arrive at Vegas at like midnight or whatever, or 9 o'clock at night. So I'm going to be trashed the next day. So if I'm going to Vegas for a seminar, I can't go the day of the seminar. I will be exhausted. So I have to go out a day. I go a day earlier so that I can get a good, you know, have a nice relaxing day and take it easy. And then the next day I'm up and ready to go and do something. But it's planning. And obviously, if I'm going on a cheap vacation to Vegas, that's one thing. But if I'm going to perform in Las Vegas and give a webinar or do something, and give a seminar and do something, then I've got to be on my toes. And actors do this all the time. They may have to make those decisions. They have to be ready to go. So everything has opportunity cost. So anyway, so like I'm saying, the bottom line is people don't value their time. Bottom 80% people don't value their time, and they don't understand what's being stolen from them when their information and everything is being given to these companies, who will then just bombard them with advertising. You know, like I have ad blockers all over the place. I don't allow any of that shit. And so we analyzed that. We looked at, there's a link to a report that Bodie already did on Google from the chat room. Here's a report from Amazon that we did today. And it talks about, where does the money come from? Where does the money go? But you know, you got to realize, and it's not just, obviously not just these 4 companies, they're already doing 1% of the GDP. There's at least that much more, another 300 billion at least is going into AI from other sources. And you can see that because you just look at NVIDIA's revenues. And they're not the only company, but they're the poster child. So they're already up to I'm sorry, this year they're up to $130 billion in chip sales, and they project they're going to go to $200 billion in chip sales. That's just NVIDIA. And then they've got suppliers, and there's data centers and all this other stuff being built all over the place, and housing the racks and the servers and the telecommunications and everything else that goes around it. So, it's getting to be a large portion of our GDP is based on an AI frenzy, which is exactly what happened in .com. So much money went to these sectors and gave you a false sense of the economy is booming and things are going great. And yes, it's not inflation, because it doesn't sound like inflation to the Fed. That's not what they measure. It's new. It hasn't been measured. So money is being taken away from companies and being funneled into AI, so it can't be spent in other places. All these companies, that aren't spending money on normal things that are measured in the GDP, not measured in the GDP, I'm sorry, it's measured in the CPI and the PPI, right? Things that are measured in the CPI and PPI are not servers, are not chip servers and things like that. Those don't get measured. So whether they cost more this year or not, it doesn't matter. What matters is that it's not looking like consumer pricing. So the economy seems to grow and inflation doesn't seem to grow, and it's all false readings because you're missing the bigger picture. You're not changing your models to account for the new economy. And that's how we blew up in 1999, and everybody was like, oh, what the hell happened? All right, and General Mills today, GIS, flashing a warning sign of a company that is down significantly in their revenues, and Target has said this, and Macy's has said this, and Walmart has said this. The consumers are tapped out, they're running out of spending power, the stores are cutting back, and so in other words, this other part of the economy where money is being drained away from is falling apart, and you're betting it all on AI. And if AI doesn't perform, it's going to be a horrible collapse. And again, and I said all this in today's post, like the .com boom, nobody was wrong in 1998 and 1999 saying the internet is going to be the next big giant thing. Nobody was wrong when they said that, but it wasn't the next big giant thing for another 10 years. In 2010, the internet stuff started ramping up because we had faster transfer rates and better chips and better distribution and so on and so forth, and companies had completed their integration of the systems and so on and so forth. You can't expect all that to happen faster. It's just there's a limit to how fast you're going to be able to do this. People aren't even trained to use it. I mentioned that somewhere today too. The percentage of people using AI in offices is fairly limited, and the percentage of offices, it was like 1% of all the companies believe they have placed AI into the office. 99% or 98% are trying, and 1% feel that they've actually done it. So there's a huge push to do internet, or AI this time around, but it's the same freaking thing, and the same thing is going to happen. If there's not a return on investment, if there's not a solid return on this $325 billion investment from these 4 companies and $325 billion investment from another 2,000 companies that are doing projects, all of a sudden next year they're going to cut those budgets and then replace it with what? And then boom, then the AI sector, the chip sector, the technology sector collapses and goes into a contraction phase. And the question is, when does that happen, and how fast does that happen, and how does it affect the labor market? Disruption. That's where we're going to be. Anyway, so I'm going to go back to the chat room. We are going to analyze what Powell is saying. He's still talking. And but as soon as he says inflation is getting under control, it's like, you're an idiot. Trump is going to initiate tariffs 2 weeks from today. 2 weeks from today, Trump is initiating serious, ridiculous, insane amounts of tariffs that is going to shoot inflation up at least 0.3 of a point, probably half a point, or even more than that, at least. So Q2 inflation is going to be out of control. And here's Chairman Powell right now saying, we're not worried. So he's lying. What he says is bullshit. And the market is reacting to bullshit, which it often does. It wants to hear the bullshit. It wants to hear that everything's fine and everything's going to be great. So unfortunately, being that this happens on a Wednesday, even if we get to the strong bounce lines, and even if we hold the strong bounce lines, it'll still be Friday by the time we're holding the strong bounce line. So if tomorrow we're above strong bounce and Friday we're above strong bounce, I still won't be comfortable being more bullish into the weekend, because you don't know what the frick Trump is going to do between one day and the next. You never know what he's going to say. You don't know what he's going to do. So we can't change our stance. We're going to maintain our stance the way it is. And we're going to have to wait until next week. And next week we have a bunch of data that will confirm or deny what Powell is saying right now. That we'll see what the inflation looks like. We'll see what consumer confidence looks like. We'll see what the economy looks like. And that's where we stand. All right, so thanks everybody for coming. And next week will be a lot more. This was a fantastic webinar, I think. So next week will also be interesting. Let's put it that way. Thanks, guys. Take care.